Real estate outlook for the second half, coming from Keeping Current Matters. I'm not familiar with Keeping Current Matters, but we'll see if they have links to whatever they're doing here. Everyone's favorite realtor, Mary Hampton, sent this to me, and she gave me permission to use it as long as I credited Keeping Current Matters. And we're going to go over this. A lot of interesting stuff in here. Let me just bear with me just a second. We got a link to who these people are. Yeah, right here. KeepingCurrentMatters.com resource. KeepingCurrentMatters.com resource. So check it out. If I can get back to the top here. All right, so let's go. We got 4 things to talk about here. Economic recovery, unemployment, prices, and sales. Economic recovery, is the economy finally showing signs of recovery? Well, we know the answer is unequivocally yes. Unemployment, what will the unemployment numbers looking like moving forward? I have no clue. We'll see what these guys say. You cannot tell me if 40 million jobs are truly lost that we're where we are economically today. Something doesn't make sense. Prices, what impact will both of the above have on home prices? And sales, what will they have on the home sales? Oop, got a typo there, folks. Is the economy finally showing signs of recovery? This is from WSJ. A strong economic recovery depends on effective and sustained containment of COVID, says economists. Well, if economists say it, must be true. 91% of business and academic economists agreed somewhat or strongly that the economic recovery depends on containing the pandemic. You can't, whatever. All right, so here, 91% of economists said that recovery is already underway or will be soon. Well, you could look at it like this. They're saying 2020, 2/3 of the economists are saying the recovery will begin in the quarter, the Q3, which we are in now. So that's what's happening. So basically, we are already in the recovery according to economists. And are economists ever wrong? No. 83% of economists said the recovery will be in some form of a V shape, a Nike swoosh where it goes down and then it just kind of goes back up like this, a V shape. I think the default here is to say Nike swoosh. It's easier to say that than say a V shape because no one wants to no one wants to go on the limit and say I predicted to go higher and then it doesn't. Hey, you idiot. The first stage of the recovery looks V-shaped after bobbing out in April. Economic activity has continued to rise into early June. An L-shaped recovery in which activity stays depressed now looks remote, and while the overall recovery may not end up as a V, it may look a lot less feeble than many had feared. I think that's probably true. Showings in North America, this is pretty interesting. Weekly showings normalized to the first calendar week of January. That's fantastic, man. 7-day moving average. Weekly showings normalized to the first calendar week. Oh, normalized. Okay, gotcha. So what you'll see here is I don't know what these numbers mean here. Weekly showings, is that, I don't know, I don't know what that means. Is that increase? Percentage increase? That's not a good graph because they're not showing what this number here means. But anyway, so I'm going to say a 20% percentage increase in weekly showings. It dropped 50% and then it's gone up. Yeah, that's a graph. It doesn't tell you anything. The housing recovery has been nothing short of remarkable, says Ali Wolf, who's a chief economist at Myers Research. The expectation is that housing would be crushed. It was for about 2 months, and then it came roaring back. And actually, it wasn't crushed just because there wasn't any supply, which is the case now. Again, all right, what is this? The Housing Market Recovery Index. Okay, so anything above 100 looks like it's growing, almost like an ISM number. Anything above 50 in the Institutional Supply Manufacturing Data, ISM. I forgot what it stands for. But anyway, if it's above 50, it means it's growing. If it's below 50, it means it's declining. I'm sure we're going to say the same thing here. If it's going above 100, it's growing in terms of the index. If it goes black, it goes down below 100, it's declining. So here you got a 6.5% increase in prices, I guess. A 17% decline, and then we're right under the February baseline of 100. But that would probably be the middle of February, I bet, right there. So we're still a little bit short of where we were. I wish I'd say what this, I don't know what that means exactly. The economic recovery. I'm not sure what the number indicates, but it says demand, supply, price, and time on the market. So I don't know what that means. But either way, went up, went down. It's going significantly up again. It looks like it might be leveling off some. Let's look at unemployment number. The consensus was for 3 million jobs to be added in June. 4.8 were added. Unemployment clarifying, not terrifying. The Great Depression, 23.6 in 1932, 24.9 in 1933, 21.7 in 1934, 20.1 in 1935. So even after we had 4 years of FDR insane policies, we had still 20% unemployment and no safety net either. So now we're expectations are 11.1 down to 4.9 by 2023, which is a survey of economic projections. Look at unemployment numbers, new filings, collecting unemployment. So the new filings are cumulative new filings. Okay, well, cumulative, I don't know, that's okay. But anyway, the people actually collecting is dropping from 24.9 to the high to 17 point. That's about a 30% decline or so. 25%. Potential buyers are coming into the market. Number of jobs added. That doesn't say. U.S. jobs surged last month, underscoring the economy's capacity for a quick rebound if businesses continue to reopen and consumers regain confidence. A recent spike in the economy virus can undermine trends, which is why do you think the governors are doing it? I was reading today, the Utah governor said we won't be free until there's a vaccine. Another Republican, Mike DeWine, Larry Hogan, Charlie Baker. Hell, you can even argue Greg Abbott. Nuts. More depth, less length. It's just basically saying we're not going to be as long-term as the Great Depression. You can see right here the Great Depression went on for 12 years. Great Recession went on for 9. I don't know about that. Years for unemployment rate to return to pre-crisis level. I don't know if that's true. All right, so unemployment rates and home sales do not have a truly direct relationship. That's interesting. So unemployment rates are going up in 1989 to 1991, and yet home sales are going up too. Unemployment rates are dropping from 1992 to 2000, and home sales are going up. Unemployment rates go up, home sales go up. Unemployment rates pretty much go down. Home sales go way high and level off. Unemployment go rates high. That would be what you'd think if there's a direct correlation. Then you got unemployment rates dropping and home sales increasing, then leveling off. So that's interesting, actually. Unemployment rates and home sales do not have a truly direct relationship. I'm interested. That's interesting. Unemployment rates, home sales, and mortgage availability. All right, so we got existing home sales right here from 2005 to 15. And here's a number: 7 million in 2005 to what's that? 5.5 million in 2015. Unemployment rate, mortgage availability. So this would be the L shape right here, right there, by the way. I don't know really what to make of that. Unemployment rates, home sales, mortgage availability. I'm not sure is it tighter in terms of tighter margins, tighter credits? I'm not sure. First, your lender or loan service may not foreclose on you to at least August 31st. Second, if you experience financial hardship, you have a right to request and obtain a forbearance for up to 180 days. And that's called the consumer from the CFPB. All right. Of all active forbearances which are past due on their mortgage payment, 77 have at least 20% equity. There you go. That's good. Oh, wow. That's pretty good, man. And so we got 77, 90% have at least 10% equity. And of course, that's only as good as what the assessment would come in at. So if they're trying to sell it, will they actually be able to gain 10% equity on a sale? Not if everyone's selling at once. I mean, so this is where mark-to-market accounting actually is a big deal, because they're saying, look, we're going to market to the assessed value, but until you actually put a contract on, we don't know what the value is until someone actually is willing to buy it. All right, so prices. Recent home purchases measures have continued to show remarkable strength, says Fannie Mae. Similarly, we bumped up our expectations for home price growth and purchase mortgage originations. Interesting. Largest range of projections on future home prices: Fannie Mae, Mortgage Bankers Association, National Association of Realtors. I don't know what Zelman is. Reuters, Freddie Mac, Zillow. I'm not sure why they don't have NAHB. Doesn't National Association of Home Builders have their own economist? You'd think that'd be interesting for NAHB, National Association of Home Builders, to have a projection of home prices so they can project buying out timber and whatnot. Some project for the current year, others for the next 12 months. All right, so basically CoreLogic is predicting a 6.6% decline over the next 12 months. We'll just say House is what German is predicting negative 1%. Zillow's not saying. Freddie Mac, Reuters, Zelman, National Association of Realtors, Mortgage Bankers Association, Fannie Mae are all saying between 3 and 4%. Large range of projections on future home prices. So that's interesting. I guess over the course of the next year. Zillow, home prices to fall just 5.5% from their June to peak to August, followed by rapid recovery. All right, home prices are showing resilience. Sale price growth has cooled slightly, but looks to be headed for an upswing in recent months. The market has tilted in favor of sellers because a lower than normal share of listings. That's the supply. Only 4.1% of current listings have had a price cut compared to 5.6% at the same time last year because the supply is down, which is always good for sellers. Year-over-year change in listings. Look at that, man. Total listings way down. This is huge. This is probably the most important. Look at that. 32% of total listings are, the total listings are down 32% in the last year. That is indicative of a price increase for the people who are trying to list. That's huge. That's a huge supply glut for sure. Does glut mean too much supply or does glut mean not enough? I don't know. A deficit in supply. Let's just put it that way. There's less supply. 32% less supply than a year ago. That's nuts. And then new listings just dropped off a cliff. Look at that. So we had 25% decline in new listings from early March to end of May. Then it went back up. 20% increase roughly in new listings from May to July, and then another 10% decline in new. That's nuts, man. This may be our strongest signal yet that sellers have the upper hand in the housing markets. Many buyers still think they can make lowball offers, but sellers are holding firm. For sale inventory has been setting new record lows this year, so sellers know that the buyers are starved for options. Yep. Despite the lack of price cuts, sellers are still able to sell their homes faster than they did this time last year. That's crazy. What impact will sales have on home sales? All right. Home ownership remains one of the main tenets of the American dream. Right here. This is critical. Here's what we said in July. Top 4 reasons why people are actually moving. They want more interior space. Exactly what they said in April. Desire to own. They did not say that in April. Move from city to suburbs. That was not in April either. More outdoor space. Number 4 was July. So July is get out of the city, a bigger home, more outdoor space. And they want to own something. All right? They want to get out of the rent, I guess. And April, we want more interior space, which is number 1 in July. We won more outdoor space, which was number 2 in April, and number 4 in July. Updated kitchen and better technology. Now it's like, no siree, Bob. We want to get the hell out of the city. We want to get into the suburbs, and we want more outdoor space. That's cool. Summer home buying season is off to a roaring start. Traffic hit an all-time high at Realtor.com of 86 million unique users in June, breaking May's of 85 million unique users. That's crazy. Percentage of agents who say bidding wars are increasing in June is 60% are saying bidding wars are increasing. That's good for the seller for sure. As cities and states and counties around the country slowly reopen, we predict the great American move. This is from John Burns Consulting. That's Mr. Burns' son. Montgomery Burns' son is John Burns. For safety reasons, financial prospects, life change improvements, personal comfort, and employment, we expect a surge in household and business relocations over the next few months that will provide new strategic opportunities for the real estate market. Man, I could not agree more. Despite the crippling and ongoing economy virus pandemic, millions out of work, a recession, a national reckoning over systemic racism, and a highly contentious presidential election just around the corner, the residential real estate is staging an astonishing rebound. All right, so that's fantastic. I'm this right here, right there, year-over-year listing changes. That's all revolves around listings, man. That's good stuff if you're trying to sell your home, or if you're trying to get cash out of equity. I had a guy email me the other day. I'll do another video on this because I think it's important. All right, we'll see you. Comments.